So what is the difference between an IRA and a Roth IRA, and why is it so hard to make sense of that? I can tell you the real reason is because most finance people suck at explaining finance topics. So I'm going to have you kind of roll back the timetables here. We're going to go back to when you were in like second grade, first learning about multiplication. Hopefully you're better at it than I was. But we're going to go down to the very basics, and I'm going to let you know what is an IRA, and what's the difference between an IRA and a Roth IRA, and how can a normal person like you use an IRA to save yourself hundreds of thousands of dollars of taxes. Perfect. So let's start out with what an IRA actually is. An IRA stands for Individual Retirement Account. Okay, so pretty easy. Let's break it down from there. Individual, only you can own it. This can't be something that a joint account that you open with your spouse. This is your money alone. Retirement is the purpose of the account. Okay, so we're not building up IRAs for the purpose of buying a house, for instance, although there are some exceptions to that. And then the third one is account. So this is actually really important because some people think that if you just put money into an IRA, it's already invested, which is not the case. So think of it as a bucket. So at the bank, when you open a bank account, you have a bucket. And inside of that bucket, you can hold cash. On your IRA, though, it's a special kind of account that can hold not only cash, but also investments. And what that means is cash obviously doesn't just automatically grow, other than maybe a little bit of interest that you get, but investments can grow significantly. So the purpose of this account is to have an individual account that is for the purpose of helping you retire by putting investments into it that are going to hopefully grow over time and create cash for you in retirement. So, let's get that out of here and talk a little bit about taxes, my favorite subject. You know, they say there are only two things that are certain in this life, and that's death and taxes. First, you have what is called a traditional IRA. And then you have what's called a Roth IRA. Now, don't get too hung up on the names. The fact of the matter is, traditional is, you could just think of it as a regular IRA. A lot of times people just don't even say traditional and they just call it an IRA. Roth IRA, on the other hand, usually when you're talking about it, you want to be specific, you say Roth IRA. The only difference between these two, they are both individual retirement accounts, but they are treated differently for tax purposes. So, let's take an example. Let's say your tax rate is 20%. And it's going to be 20% for the rest of your life, no matter what. Any income that you get is taxed at 20%. You put $1,000 into your traditional IRA. What this is going to do is going to create a tax deduction of $1,000. So basically the IRS is going to say, oh, you made $1,000 less this year because you put it into the traditional IRA. Now what that means is if we multiply $1,000 by 20%, which is your tax rate, we are going to get a $200 tax saving. And you're thinking, okay, great. Well, we love tax savings, love not paying taxes, but there is a catch, and it is a big catch. Let's say this $1,000 that we put in here doubles over time because your investments grow. Now you have $2,000 in your traditional IRA. And you're retired now and you need the money, so you pull out those $2,000. So you get a tax deduction on the way in, but on the way out, you have to pay taxes on it. So if we multiply this by the same 20%, because remember we're assuming that your tax rate is going to be the same throughout your whole life, you are going to pay $400 and I'm going to put a negative here in taxes. And so you can see we're going to end up with $1,600 in the end. Okay? This is the math of a traditional IRA. You get a tax deduction up front, but you have to pay taxes when you pull it out. Okay? Now, Roth IRA, very simple. It's the opposite. We're going to use the same assumption, 20% tax, or we're going to put $1,000 in. So here's the thing. Since you don't get a tax deduction up front, you are actually paying 20% taxes on this before you put it in, basically. So what we're going to say is instead of starting with $1,000, we are going to have a negative $200 tax bill up front because we didn't get that tax deduction over here. So we're going to start with $800. And let's say your $800 doubles and then you want to pull it out. Okay? So 800 times 2, you're looking at $1,600 in your Roth IRA. Or remember, same investments returns, it's doubled. But there is no tax on the way out. And so what you see is what you get. If you have $1,600 in your Roth IRA, you can pull it out completely tax-free and get your total of $1,600. Okay, now you might be looking at me and thinking, okay, Luke, you just showed me these two examples and I put $1,000 in and I got $1,600 out. Why do I care about the difference between these two? The big difference here is going to be in this assumption, okay? We are assuming in this example that you have a same 20% tax throughout your life flat. And if you don't know this, that's not how taxes work in the United States. So what we're going to do is be a little bit strategic about this because when my income is low, let's say I'm married and I make $50,000 a year, and I put it into my traditional IRA, I'm only going to get a 12% deduction. So in that case, if I'm low income and I'm maybe in the 12% tax bracket, then I might want to put it into the Roth IRA because I know my tax bracket's going to be higher later when I pull the money out. On the other hand, if I'm making $1 million a year, my tax rate might be upward of 40%. And so I'm thinking, well, when I'm retired, I'm not going to be making $1 million a year. My tax rate is not going to be 40%. So I'm going to get the tax deduction now, save the 40% now, and when I pull it out, my tax rate is actually going to end up lower than when I put it in. So that's the thing. We have to be strategic about when we want to put it in. General rule, when your taxes are high, we want to use the traditional IRA. When your taxes are low, we want to use the Roth IRA. So, off with that. And let's talk about why we actually like the Roth IRA more anyway. Okay, so this is an interesting thing because you might think that it's kind of give and take with the IRA, traditional IRA and the Roth IRA. It's a little bit of a guessing game, and that is true, but your Roth IRA actually comes with a bunch of other advantages. First of all, your principal, which is the amount that you put into the Roth IRA, is always available. And what that means is basically, if I put money into a traditional IRA and I pull the money out before age 59 and a half, I'm going to get taxed on it and I'm going to get penalized because remember, this is a retirement account. Government does not want you pulling from it before you're 59 and a half. With a Roth IRA, though, your principal, so the amount that you put in, is always available. If I put $10,000 into my Roth IRA, I can always pull at least $10,000 out, assuming that the $10,000 is still there. And there won't be any tax consequences to that. So this gives you flexibility in case you need to use your Roth IRA to fund other expenses. Another thing that we like about it is tax-free growth for your heirs. Now what that means is if I have an IRA with $1 million in it and I die, say it goes to my son has to pull money out of that IRA every year, and at the end of 10 years pull the whole thing out, and he has to pay taxes on the whole thing. With a Roth IRA, on the other hand, my son can hold on to the full account balance for the full 10 years, let it grow completely tax-free, and when he pulls out, he doesn't have to worry about it. So your kids will thank you if you use a Roth IRA. Another reason to consider a Roth IRA is there are no RMDs, which stands for Required Minimum Distributions. With a traditional IRA, the IRS says, okay, you have never paid tax on this money, so we really want to make sure you pull it out at some point. So at a certain age, usually around 73, you are required to take money out of your IRA and pay taxes on it. The Roth IRA doesn't require you to take money out of it ever for your entire life plus 10 years of your kids' lives. So you save yourself from having to pull out money if you don't want to. Another advantage, generally speaking, when you're married, your tax rates are lower. What actually happens though is people put money into their IRAs and then one spouse will pass away several years before the other, and then all of a sudden the tax rate doubles when you are single after being married. And so it can actually make a lot of sense to put money into a Roth IRA. If one of the members of the couple pass away, then you can take the money out of that Roth IRA to pay them without having to pay taxes. As a quick recap, let's go over what you need to know here. Traditional IRA, which is also known as just an IRA, you pay taxes later. And what that means for you is if your taxes are high, then this is good. If our taxes are high, we want to use the traditional IRA. Now, if we take a look at the Roth IRA, pay taxes now. Okay, because you're not getting a tax deduction when you put money into your Roth IRA. So what that means is when your taxes are lower, then you want to use the Roth IRA. So hopefully now you know what an IRA is, what the difference is between an IRA and a Roth IRA, and how you can use these vehicles to save you hundreds of thousands of dollars of taxes. And if you need any help opening an IRA, reach out to me. I'm happy to help you get that open, get that invested, and get you saving in taxes. Contact information is in the description.